Here's the outline for today. It will start at the very basic ground floor level, rights versus obligations, and the key differences between buyers and sellers. Then we'll get into that exercise and assignment process where I said OCC's role will be discussed there. Then it's all about the exposures in terms of the Greeks, delta, theta, a little bit about vega, and that'll lead us into a discussion on option premium, intrinsic versus extrinsic value, and then quite a bit of discussion at the end comparing historical versus implied volatility, the importance of that measure when it comes to option prices, and what it means for the option buyer. So we're going to start at the very ground floor. Anytime an investor buys an options contract, they are paying for the right to execute some transaction in shares of stock. It might be buying, it might be selling, it depends on which option it is. If the buyer has purchased a call option, they have paid a debit up front and now own the right to buy stock at the strike price. If the stock price moves higher, then you would expect the right of the call buyer to purchase shares at the strike price should increase in value. It doesn't necessarily happen. We'll discuss those other factors throughout the presentation today, but you can say that a stock price moving higher has a positive influence on the value of the call option. Buyers of put options have similarly paid a debit up front and they own a right to execute a transaction in shares of stock. But in the case of puts, that right is to sell stock at the strike price. As the share price moves lower and lower, you would expect that share price movement to have a positive influence on the value of the put option. So you can see straight up front the most simple outright single leg trades, buying call, buying put, have their directional bias. Buying calls is a bullish trade, buying puts is a bearish trade, and the objective or motivation here is to capitalize on that move. Now, the option holder will go through with this right to buy or sell shares if they exercise their options contract. Now, I'll say right up front, this does not happen too often. Statistics from OCC consistently show that the vast majority of options that are opened are closed before ever reaching expiration. Turns out to be about 70% of all open positions never see their expiration date. Of the remaining amounts, about 20% of all open positions are held through expiration and expire worthless. That may contradict one of the myths that is often circulated about this industry, that most options expire worthless. It's not true. Most are closed. 20% or so are held through expiration and expire worthless. And then the other roughly 10% are exercised at some point, whether early or at their expiration date. To exercise, the buyer would communicate with their brokerage firm their intentions to exercise their right to buy or sell shares of stock, or they may allow themselves to be subject to what is known as auto exercise. I'm going to discuss that in a little more detail a few slides from here. But either way, the buyer has decided to exercise the right that they have purchased, and in exchange for not just the premium, they will also pay, say, the strike price in the call in the case of the call, or receive the strike price in the case of a put option. Now, here's an example: an option premium of $3. Just keep in mind, premiums are quoted on a per share basis. So $3 option premium translates into 300 net dollars. Buyers of options are often doing so because they can control their risk. An option buyer has control of 100 shares, but only risks the premium they paid. This options investor pays $300 and they own an option. It's an asset. It can only go to zero. So they can't lose more than $300 while the option exists. I have to caution investors that this maximum loss of $300 exists while they have the option. If they exercise into shares at any point in time, The maximum loss now changes to be consistent with a stock position. That's something that those new to options may fail to see. When they buy an option, they might think, well, that's it. That's all I can lose. And that's true while you have the option. If that is exchanged, of course, into shares at some point, then the risk profile is very different. Let's look at an example of how this would play out. Um, Exercise, and what the cash exchange is going to be. Stock is trading at $79, and the investor purchases a slightly out of the money 80 strike call option, pays that's $150. Come around to September expiration, stock's trading up to 84. Now, the decision to exercise at this point likely means something has changed. Remember, this investor bought an option because they weren't interested in buying 100 shares of stock. They were more attracted to the lower cost and lower risk of the options contract. They paid $150 instead of buying shares for $7,900. They bought this option for $150. So the decision to exercise likely means something has changed. Perhaps the 79 level was a strong support level and the investor was bullish. But if the support level broke or didn't hold, the stock may have suffered a major sell-off, and that was why this investor decided to not go the route of buying shares and instead purchase the options contracts. But now let's say that the support level held and stock's trading up to 84 now, and the investor is more bullish. Their market bias or opinion is different. It's more bullish, and now they are more comfortable buying shares of stock. The option played its role. Now let's get stock. So if they exercise, they pay the strike price, which is 80 times 100. That's $8,000. Now they've also paid $150 for the option. That's gone. So this is actually a total cost of $81.50, and now owns shares valued at 84. Now, if they had bought the stock outright from the beginning, they'd be long from 79. But remember, there was concern there. There was risk there. What if the support doesn't hold? I'm not comfortable with all that risk. Now that it's worked out and they're more comfortable, they're owning shares, but their break-even point now is up to $81.50. They paid $80. That's what the strike price was. They lost the premium. So $81.50 is now where they're long from a worse break-even point, worse cost basis. But the option provided them a bit of comfort in case they were wrong at the beginning of that trade. Now, more than likely, the investor closes the position. As I said earlier, almost 3/4 of all positions are closed. So rather than exercise, it is more common to see investors trade out of the position. The option is now probably worth right around $4. That's calculated simply as the intrinsic value. 80 strike call versus 84 open market price, $4. So this investor may want to take their profits and close the position. Now it's estimated profit of $250. That's comparing $4 that you might be able to sell it for to the $1.50 you purchased it for. In practice, it's unlikely that you'll get $4. Most likely, anybody putting up a bid or taking the other side of your closing sale transaction is not going to pay $4. They might be paying just less than that, maybe say $3.90, and you have to sell it at that level just to entice the other side. So that's an example of how exercise works. But how about the communication flow? This is also important to understand. The communication begins with the investor. The holder or buyer of an option contract has purchased the right to trade, either buy or sell shares of stock at their discretion. That's what they paid for. So the decision starts with them. At any point in time, up to and including expiration day for equity options, this investor can communicate with either their brokerage firm, or a lot of investors have accounts directly with a clearing member firm of OCC, Interactive Brokers being one of those. So the investor communicates to their firm, whichever way it is, and if it happens to be a trading firm that's not a clearing member, all of these firms in the industry clear through somebody. So the communication goes ultimately to the clearing firm, and then from the clearing firm to OCC, who then receives all the exercise instructions and facilitates the exercise and assignment process. A couple things to say about that. First of all, the assignment process is random, and we're here to talk about buyers, not sellers, but many of you probably sell options as well. The assignment process is random and works in the opposite direction. OCC randomly assigns clearing member firms who have open short assignable positions. And then those clearing member firms can do the same thing. They randomly assign through an approved method an investor that they have an open short assignable position. And they might have to communicate that through a brokerage firm as well, but the opposite direction. And that's how assignment is carried out. I also want to talk about what I mentioned a few slides ago, the auto X. What is that? The more formal term for auto exercise is exercise by exception. Now, this only occurs in the circumstance when the investor doesn't communicate anything to their brokerage firm. OCC hasn't received any instruction at all on what to do. When that happens, the industry has to do something. There has to be, we'll say, a default process to manage those situations. And what OCC does is it will calculate whether or not the option is in the money. And if it is in the money by at least 1 penny, then OCC will exercise those contracts. That's what's known as auto exercise. If the investor doesn't say anything to their firm, OCC doesn't know what to do. There is this analysis. If the option is 1 penny or more in the money, and OCC hasn't been given instructions, then the option will be exercised on the investor's behalf. Very important to know that if you're buying options. If you have a long call option and you don't want the shares and the option is slightly in the money, you need to contact your firm and say, I don't want the shares. I want to abandon this option. If you don't do that, OCC is going to follow through. A few key details regarding exercise by exception. First of all, that in the money calculation of a penny or more is made by comparing the last traded price in the stock during regular market hours on a national exchange and comparing that to the strike price. The other key detail there, which follows, is that after hours activity is not considered. If the market makes a big move in one direction or the other after hours, as an option holder, you may have a different opinion on what you want to do with your contract. If you own a call, it's a little bit in the money. Then all of a sudden, for whatever reason, during after hours activity, the market gets crushed. You're not required to exercise that option just because the market's closed. Call your firm, call up Interactive and say, I don't want to exercise this option. I know it's in the money based on the last traded price of the stock, but I don't want it. I don't want to exercise. And you have every right to abandon that options contract. It doesn't happen too often, but it does happen. From the other side, looking at my career, 23 years in the industry, I believe maybe a half dozen times or so as an option seller, I was surprised by what decision was made by the option holders. Whether that meant I was assigned on an option I didn't expect to be assigned on, or the other way. I expected and welcomed assignment and didn't get it. It can happen. And again, just remind yourself, the option holder always has the right to do whatever they want to do. And this exercise by exception process only comes into play if no communication is made from the investor. Now let's talk about the exposures and the risks and potentially the rewards that you are looking for when you're an option buyer. And I'm going to start with overall description of the Greeks. Now I'd say if an investor is scrutinizing the price of an options contract in some way, they are doing a Greek analysis, whether they know it or not. If you're looking at how far might the stock need to go for me to be profitable, how much premium am I willing to pay, what's too much, if you're doing those types of thoughts process, you're doing some kind of Greek analysis. The classic Greeks The popular 5 Greeks are listed here: delta, gamma, theta, vega, rho. As an option buyer, I'm going to forecast where I'm going with this. An option buyer is trying to capitalize on delta and wants the move in the stock price. Delta is sensitivity to stock price. Wants the move in stock price to overcome theta, or time decay. Now, vega, and I'm going to discuss volatility because it's so important. Changes in implied volatility might work in your favor, or it might work against you. So all these 3 Greeks are going to come up today. Now, gamma is also very important. It's tied to delta, so I'm not going to get too much into gamma today. Gamma is basically the acceleration of your deltas. I'm going to focus on the delta that you're trying to capitalize on, in addition to focusing on theta. Vega, rho is the expected change in option value when interest rates change. Those value changes tend to be small. Interest rate changes don't happen too often. When they do happen, they occur at fractions of 1%, and rho is expressed as a 1% change. What would the option value do? So rho doesn't play too significant of a role when you're analyzing your exposures. It's really going to come down to these 3 today, starting with delta. This is the option values sensitivity to stock price movements. As the stock price moves, what happens to the option price, up or down? For each 1 point or $1 move in the stock price, what might we expect to witness in an option value? Deep in the money options are going to have very high deltas, and they're going to behave very much like stock. $1 move in the stock is going to translate into roughly a full $1 move in the price or value of an options contract. These are going to be your more expensive options. Most trading occurs at the, say, at the money area, not necessarily exactly deltas of 50, but roughly right around 50, or out of the money options. These are going to be less expensive than their in the money cousins and offer lower risk since they're priced less, and potential for reward should you get that move in the stock price. And this is the key difference between buyers of options in general and sellers of options. Buyers know that time decay is working against them. They need a move in the share price to be in a timely fashion and of a certain magnitude in order to be profitable, in addition to being in the right direction. So it's really those 3 things: direction, timing, and magnitude that need to work in the option buyer's favor for profitability. And that's the motivation of the buyer. I'm going to spend a little bit of money, and if I'm right on direction, timing, and magnitude, I can have some very healthy gains. Sellers are doing the opposite. Sellers are interested in lack of movement. There are certainly selling strategies that would be characterized as bullish. Other strategies that you could say are selling options that are bearish. But all selling strategies, all of them, will profit from a consolidating or neutral market environment. Sellers are interested in capturing time value and don't want to give back more in delta. Option buyers want the delta move in their favor to a greater extent than they give up in time decay. Let's look at call and put deltas. Now, first I'll start out with the 2 different definitions that you might come across when we say long and short. Normally, when you're talking about the broad open market, you say, well, I'm long the market. What you mean to say is that you're bullish. And if you're short the market, you're bearish. In the options space, there's actually 2 different definitions. When you're long an options contract, it means you bought it. You're the buyer, you're the holder, or you're long the contract. You could be long calls or you can be long puts. That just means you own the contract. That's all it means. Nothing to do with market direction. But there's also long and short deltas. This definition is consistent with your more classic market direction. Long deltas is trying to capitalize on a market move higher. It's bullish. Short deltas is bearish. So keep that in mind as we walk through calls and puts and the four different sides. Calls themselves have positive long deltas. This is the positive correlation. Stock price goes up, call delta is going to keep moving higher, and the stock price or the option price is going to be influenced higher. It's all consistent. Stock price down, option price influence lower, delta keeps moving lower. Positive deltas. If you buy a call option, you're long the contract, and you're also long deltas. You're purchasing or you own this contract, which has long deltas. If you sell a call contract, you are short the contract and you've sold the long deltas to somebody else, so you are short deltas. Makes sense. If you own calls, you want the stock to go higher. It's bullish, long delta. If you're short calls, you want the stock to move lower. Short deltas, bearish. It's going to look a little different from here on the puts. Puts themselves have negative deltas because the correlation is now opposite. When the stock price goes up, your put value and your put delta goes down. Negative correlation, negative deltas. So the put buyer is still long the put contract. They're long puts, but they've purchased a short delta option. So they're short deltas, meaning they're bearish. There's your market outlook, short delta. Long put is short delta, bearish. Short puts means you've sold the contract and you've sold those short deltas to somebody else. They bought the short deltas, so you are long delta when you sell a put option. Short puts is long delta because you're bullish. A move higher in the stock price is going to work to your favor when you sell puts. There's how delta is with your classic four-sided trades. And those four sides, long or short call, long or short put, every option strategy there is put together at that basic level, those four sides. You combine those four with each other. You can do different volumes, different expirations, put two pieces together, three pieces together. Maybe you include stock, maybe you don't. The entire universe of options trades comes from those four sides. I want to talk about that, the dynamic feature of delta just through an example. Stock's trading at 100, and here this comes from the OIC website calculator, options calculator. Stock price of 100, and we're going to look at 100 strike call. Expiration date really doesn't matter. This is 49 days to expiration, and just putting in any volatility rate. Calculating what the call and put prices are. We're going to focus on that, along with identifying, well, here's the deltas, and here's your long deltas and short deltas on the put side. Now, what this is telling you at a snapshot, if the stock moves $1 higher, I would expect, we're just going to focus on calls, forget about puts for now. I would expect the call value to increase by the delta amount, or in this case, 53 cents. So as we're looking at this, if the stock goes up $1, 306 plus 53 is 359. That's what I think the option is going to be worth, with the stock moving up $1 to 101. Here we got 101. Option's worth 362, not 359. It's worth 362. Now our delta is 58, and it's because of this dynamic feature of delta. It's representative of $1 move in the stock price, but it changes all the time. Even within the same day, as the stock is going from 100 to 101, every dime, every quarter that it moves, the delta is going to be changing, and in this case, moving a little bit higher as the stock moves up. So that 359 was our snapshot estimation. Gives you a good idea, but you know, as the stock moves that dollar, along the way, the delta is going to go up from 53. So when you do have the full dollar move, it's actually going to affect the option value by a little bit more. In this case, 3 cents more. This might be helpful if you're very specific with your, say, entry or exit points. You would want to know that. If you think the stock's going up $1, you don't have to put in your offer at 359. You can raise it by a few pennies, because you know that the delta is an estimation that's going to be a little bit different. Works the opposite way on the downside. If the stock went down by $1, just looking at our starting point of 100 with these numbers again, 306, stock moves down $1. Delta's suggesting that the option value is going to drop by 53 cents. That means the option would be worth $2.53. It didn't lose that much value. It's worth $2.56. Because again, as the stock is dropping and it's moving from 100 down to 99 all along the way, the delta itself is slowly decreasing. So it didn't actually lose a full 53 cents. It lost something a bit less than that. All of this here is just to showcase the dynamic feature of all of the Greeks, and specifically here with delta. One of the other definitions that I had learned way back when I started in this industry was that delta is used to determine probability of an option finishing in the money. This is not a precise mathematical computation. It's not exact, but it's generally understood to be an acceptable definition, that a 70 delta call has a 70% chance of finishing in the money, or a 30 delta call has a 70% chance of finishing out of the money. And you can use this perhaps to help you with strike price selection, or at least give yourself a starting point. Whenever anyone asks me about selecting strikes, certainly there's nothing wrong with having a rule that you're comfortable with. You always do things the same way. Many investors do that. Nothing wrong with that. But as an educator, I wouldn't be able to identify any rules that an investor should use. I would say either use a rule or treat each circumstance unique. And depending on the premium amount, your risk tolerance, your confidence level, some trades you might choose to buy a 30 delta option. Others you might choose to buy a 15 delta. Others you might look for an in-the-money option and buy a 70 delta. It depends. It depends what your perspective is on that particular trade. But this could be a starting point. Maybe you always start with a certain delta and then you move around up or down depending on your confidence level and how pricey the options are. When I say pricey, how pricey are these options? I'm really talking about the extrinsic value, which we're going to build to as we start our discussion here with theta. This is very simple. This is of the option value sensitivity to time with the passage of 1 day. What might we expect the option to lose in value, all else equal? Now, like all Greeks, this is an estimation. All market participants who are putting in bids and offers are ultimately going to determine whether or not this option actually decays. The Greek is suggesting something, but what if there's a little more demand that comes into these options? Is the option going to lose 8 cents tomorrow? It might not if bids are coming into the market. So keep that in mind. These are estimations. They help guide you to understand where your risk is and where your potential gains are. But in sharp contrast to delta, the option buyer wants delta working in their favor. They want those stock price movements working in their favor, and they are conscious of this natural decay of each option contract in the form of theta. Now, I did want to throw this in here. I won't spend too much time here, but generally long options have negative theta, meaning when you buy them, you're suffering from time decay, and short options have positive theta. As a little educational lesson, I asked this question: is it possible for a long option to be positive theta, meaning that from 1 day to the next, all else equal, the value of the option actually goes higher? And the answer certainly is yes, from a generic sense, and I'll explain it. If you happen to purchase an option below its intrinsic value or below its level of parity, then with each passing day, you would expect its value to gravitate up towards its level of parity. Then you'd have positive theta. Now, you wouldn't expect that to ever occur. You'd be very fortunate if you ever found that in equity or ETF options, but index options, it happens. And that's why I have this question in here. If you happen to be trading or you're looking at prices of index options, deep in the money put options often do trade below their intrinsic value because they can't be exercised early. Think of it this way: if somebody offered $999 to you today, and as part of that, you committed to paying them back $1,000, but you knew you didn't have to do that for a full year, you might take that and use that money you're getting today, invest it somehow, and very willing to pay $1,000 a year from now. So in effect, locking in a $1 loss because you're getting paid today and you don't have to pay anything back for a year. Now, if that person said, well, I might call this $1,000 away from you tomorrow or next week or next month, whenever I want, that's consistent with, say, the American style exercise, all of a sudden that doesn't look so attractive anymore. But if it was European style, can't be exercised early, I'm going to keep this money for a full year before I have to pay the $1,000 back, that looks a little different. And that's what you often see in the index product that has the European style exercise, that those options will trade below intrinsic value. And then with each passing day, all else equal, the value actually gravitates up towards its level of parity. Now, this theta number is displayed on a calendar day basis, not trading day. It is true that 3 days come out over the weekend, 4 days on holiday weekends. That is all true. But there is risk in those weekends, or a buyer has 3 days of time where something could happen in this world somewhere that triggers the market to move in a big way. So there really is 3 days of risk for the seller or potential for the buyer for something to happen, and buyers have to be conscious of that. Ultimately, buyers are looking for the delta gains, that is the stock movement directional gains on their option, to offset the theta loss. You could get the move you're looking for in the stock, but if it takes too long to happen, it might not overcome the theta loss. Only the time value portion decays. Also important to keep in mind, if you do have or purchase an option that has both intrinsic value and time value, make the calculation, the simple arithmetic, to split that premium into two. I'm about to showcase that here again on a chart, and realize that only the time value portion is subject to decay. And before I put that up, and we get to that extrinsic value discussion, let's just do a few more things on theta. The math is simple. And if an option's trading today at 350 and the theta is 3 cents, here's your aggregate value of the contract, then the expected value, all else equal, is 347. If you're looking for next week or 2 weeks from now, you can use this number of theta and try and estimate, but know that that number is not going to be correct, because theta is not going to be 3 cents every day. Theta accelerates as you approach expiration. Here's how that looks. First of all, in the money options have relatively little, out of the money as well, relatively little small amounts of time value, and then they'll experience this mostly linear, not perfectly linear, but mostly linear decay as the option just sort of slowly gravitates towards parity. At the money options behave differently when it comes to decay. We're looking at this tipping point here, which is roughly around 40-45 days till expiration. You have this tipping point where theta, the natural decay of the contract, begins to accelerate rapidly. Buyers need to be aware of that point. It doesn't mean you can't buy options that are 6 or 7 weeks till expiration. You certainly can. You just want to be aware of where this decay is. Buyers don't want decay, of course, but buyers also are conscious of the premium they're paying, and they want enough time to be profitable on the trade. Now, a buyer can go way out here, 9 months or 12 months, and experience very little time decay. But keep in mind, if you go that far out, the sensitivity of the option itself is going to be less than the shorter term counterpart. Given a strike price, if the stock makes a nice big move, these shorter term options are going to experience much greater gains than the longer term ones. That's what you give up by going out this far in time. Here's your tipping point, 40 days or so, there's nothing wrong with buying options there if you have a market opinion that's consistent with a 6-week time frame, or even shorter. You know when you're the week of expiration, you've got the fastest rate of decay that you'll ever see. But the premiums are also relatively small. So if you think a move is coming this week or next week, you might be willing to accept that decay. Again, weighing those two things. I know I'm going to suffer decay. I need to overcome that with the stock move itself. And when you're looking at premiums, here is that analysis of intrinsic versus time. Intrinsic is very simple. It's the in the money amount. For calls, it's those strike prices below the stock. For puts, it's the strike prices above where the stock is currently trading. If that's the case, how much is it in the money? How far below the stock is this strike price? Or how, in the case of calls, and in the case of puts, how far above the current stock level is the put strike? Those are in the money options, and you can calculate that distance. That distance is the intrinsic value of the options contract. Anything else, all of the additional premium in excess of intrinsic value is time value. For out of the money options and even at the money options that have intrinsic value of 0, of course, that means all of their value is time value. Once you've reached expiration, there is no more time. Nothing can change. Nothing can happen. We've got no time left. So options are only worth intrinsic value at expiration. Really going to put the same thing up on the screen on this slide here. Just like the visual of how it separates the two. On one side, you have the option premium here broken up into intrinsic. And I like it because it showcases intrinsic is sensitive to stock price movements, not time decay, not volatility. Intrinsic value is only sensitive to stock price movements. And this difference here between stock and strike. Buyers who are holding an in the money option want the stock to keep moving so the intrinsic value continues to go higher. Or if you buy an out of the money option, it has no intrinsic value. You want the stock to move higher to influence the strike, to influence the premium of the strike, and to become an in the money option. Intrinsic sensitive to stock price. Time value sensitive to all these other factors. Interest rates and dividends are largely constant. Time value we just talked about. I'm about to get into volatility here. These pieces on the bottom, these 6 entries are the inputs to an options pricing model. If you wanted to calculate a theoretical value, put in all these inputs, and the output is the option value. Let's finish up with a discussion on volatility. First, I will define historical volatility is what we've seen in the past, what the stock has already done. And I'm going to leave that definition there because I'm going to talk about historical a little more on the next slide. Implied volatility, in contrast, is looking forward. It is the volatility that is in the market price of an option, the volatility level that justifies the price of an option. Thinking back to the pricing models, if you input stock price and strike price, days to expiration, interest rates, dividends, and you left volatility as an unknown, and then inserted the observed option price or your traded option price, you can then calculate what volatility level justifies that price. Move the option price higher, and you'll see how that affects volatility. And that's what implied volatility is. Now, looking at historical, all I'm going to say here, just comparing these different hypothetical stocks with looking back at what the stock has already done. Stock A has seen or witnessed 15% historical volatility. It has the most amount of observations here at the mean and the tightest range. Stock C, on the other hand, highest level of volatility that we've seen, lowest number of observations here around the mean, and higher, wider range. If you were pricing options, you're interested in looking forward at implied volatility. Given no other information, you might price options in stock C higher than these other two because of what you've seen in the past. But you should be looking at least a little bit more than what the stock has done. The classic example here is earnings, and stock C may have just had earnings, and that's why we saw the historic level, say, and you can choose your level of your range of historical volatility measures. You can look at 10 days, 30 days, 90 days. Let's say we're looking at 30 days. If the stock C just had earnings a few weeks ago, this might explain that. And if stock A has earnings coming up in 2 weeks, that might explain why it looks like this. And so the implied volatility of stock A might be higher than stock C just because of what the options market is looking at. All of the factors that the options market is incorporating to price the contracts include not just what the stock has done, but what might move the markets in the future. Earnings announcements is certainly on that list. Fed announcements are on that list, or a big unemployment number. We just had a presidential election. All these things upcoming in the future are going to drive bids and offers for future stock price movements, and that all moves implied volatility. The question is, will implied return to its historical level? Oftentimes, implied volatility is referred to as a mean reverting measure, that it's going to revert back to its long-term mean. And maybe it does, but it's not necessarily true. It's not a rule that it has to. There could be a change in circumstances, a change in business structure, for example, that means a new normal has been set for implied volatility. But even if it does revert back to the mean eventually, it can often be a difficult question knowing when. When will that happen? So rather than try to necessarily dissect it, there are a few measures you can use, which I will get to. But the key point is to compare implied volatility to previous levels and then form some kind of opinion about where you think it's headed. Now, it's very difficult to predict where implied volatility is going. It's changing all the time. But if you do notice your option price not changing in the way you would expect it, I get this question all the time. My own calls, I've seen the stock move up by X%. Why didn't my calls gain in value as much as I thought? The answer inevitably comes down to changes in the implied volatility level that are different today than they were back when you bought the option. You bought it a few weeks ago. The market was pricing in a certain level of uncertainty. So maybe the stock did move in your favor, but now 2 weeks have been removed, and there's a lot less uncertainty about what's looking ahead until expiration. And so the market is lowering its volatility assumptions. It can also work in your favor. By the way, you could have, for whatever reason, something surprises the market, news or something is put on the calendar that was unexpected, that increases volatility. And as a buyer, you can have that work in your favor as well. And that's very simple to understand. All else equal, implied volatility changes will affect option prices. As volatility goes up, then the range of possible expected future prices goes higher. And that will increase both call and put prices. As implied volatility decreases, that range of potential future prices that the market is expecting shrinks, and call and put prices both decrease. I'll also say that the sensitivity to option prices with respect to changes of volatility increases as you go out in time. And let's just say compare an option expiring in a day to one that expires in a year. If you moved implied volatility up by 1%, the options expiring in one day are really not going to be affected. The future values of the stock, which is future values just one day from now, are not going to be affected very much if you change implied volatility by 1%, say from 35% up to 36. Really not going to make a difference. But that change going out a year, if you increase volatility by 1%, but now you've got a year to incorporate that increase in volatility, then yes, that range of stock prices will widen, and those longer term options will have a bigger effect on those volatility changes. I often get asked, how do I know if volatility is high or low? And this is where it gets difficult and can be challenging for a lot of investors who might not have access to tools and resources that can help them make this determination. But really it comes down to knowing where historical data is, but now I'm sort of merging these terms and not using historical in the sense of what we've seen in the stock, but historical in the sense of what we've seen in implied volatility itself. So historic levels of implied volatility itself, and comparing the current levels of implied volatility to that. Current levels of implied volatility compare, or how they relate to historical volatility, which we discussed at the beginning of this volatility segment, and implied volatility itself in the past. And you have to do that kind of comparison. If current levels are higher or lower, then you have a further decision to make. Do I want to lean my trading decisions more towards buying because volatility is low, or maybe lean towards selling because volatility is high? That's another decision to make. Now, there are a few tools or pieces of analytics you might look at or look up, just to name a few of those, because it can be a rather difficult or time-intensive analysis to do this on your own. IVOL rank, for example, compares the current level of implied volatility to a range over a defined time frame. It's rather simple, just takes the high and low of that range. Given an observed range of 20 to 60%, and we'll say that's over a year, that's normally the way it's expressed. If the current level is 40%, that's right in the middle. That would yield an IVOL rank of 50%. If IVOL rank is 0, that means the current level is the lowest of the year. So say IVOL, if the implied volatility was 20%, IVOL rank would be 0. And if IVOL is 100%, that would mean it'd be up here at 60. So it's just comparing current level to a range. And where does this current level sit within the range? If you followed all of that, a 30% current level given this range would be 1/4 of the way up, or an IVOL rank of 25%. So that's one measure, just looking at those three numbers: low, high, current. IVOL percentile is a little different. It looks at the percentage of days that implied vol has been lower than the current level. So it does incorporate all of the observations over the course of, say, a year, where, say, an IVOL percentile of 60% means that previous levels have been below the current level 60% of the time. So there's a key difference between the two. Percentile will incorporate all of the observations in the given time frame, and IVOL rank just looks, as I said, at those high and low numbers, and that would be it.